Senator Young.
Well, thank you, Mr. Chairman. It's very important. I know a number of our colleagues have brought up the government shutdown. We've had an opportunity recently. We'll continue to have opportunities to vote on a clean, continuing resolution. We can immediately open government up again. So let's keep that in mind. This is a great hearing and an important hearing. This hearing on the taxation of digital assets comes at a critical time. Around the world, countries are grappling with how to regulate cryptocurrency and blockchain technology. These technologies, of course, hold promise for innovation and financial tools, but they also raise concerns, which have been articulated today by many of my colleagues, about transparency, compliance, and national security. The IRS's revenue ruling 2023-14 has highlighted some of these challenges. Many worry that the ruling is premature, difficult to administer, and inconsistent with longstanding tax principles. Taxpayers want to comply, but they need rules that are clear, practical, and fair. The President's Digital Asset Working Group report published in July has suggested that staking rewards should be taxed based on when there's a realization event, that is when those assets are sold or exchanged, not at the moment they're created. Mr. Samansato, if the current revenue ruling 2023-14 is inconsistent with these principles, should the IRS consider rescinding it and replacing it with guidance that defers taxation until disposition, just like with other types of property, until Congress weighs in?
Yes, we've called for that at Coin Center for several years since the guidance has been issued.
Thank you. Mr. Zlatkin, how does leaving revenue ruling 2023-14 in place affect the U.S.'s ability to attract innovation and capital in this space?
Thank you, Senator. So this is one of those examples where I think Ms. Warren is incorrect. I think that minors, people who self-create property, this ruling actually addresses this issue about whether tax should occur upon receipt or whether it should occur, as with other forms of inventory and self-created property, whether it should be when you dispose of it and monetize in the form of cash. There's an argument to be made, certainly, I think, and people have tried to make this argument, and have been unable to do so. The IRS has disagreed that should be upon when you monetize the investment. You should be taxed when you monetize it, not when you create the property. So I think rescinding it is extremely important. It will attract more mining activity into the United States. We discourage that by taxing parties only when they receive the mining rewards themselves or when they stake through validators within the United States.
Thank you, sir. Ms. Kramer, from a tax practitioner perspective, what could the consequences potentially be, positive or negative, if the IRS were to rescind the revenue ruling in the near term while Congress considers a more comprehensive framework?
Well, it would be different from what the interpretation of dominion and control is, where you have access to it. And the difference is, the issue is, as Mr. Zlatkin said, that is it self-created property or is it income that you've earned for performing a service? And so that's really what the issue is here. And self-created property is very often something that you know, livestock, or you bake a cake or whatever. And the issue is the creation of the adding the block or the getting the reward going to be treated as a service, providing a service? And that's really what the issue is.
Thank you, Ms. Kramer. Mr. Samansato, my time will soon expire here, but I know that this hearing is intended in part for us to begin to find a path forward that will help us integrate digital assets into our tax code in a way that provides certainty while encouraging innovation. Sir, while digital assets are evolving quickly and Congress risks being a step behind, from your perspective, what principles would you emphasize should guide us if we want to design tax rules that remain relevant and workable even as technology continues to advance?
Yeah, so I think it's a couple. I think one is putting kind of the individual user first, right? These networks are meant to be democratizing forces for transferring value between people. And a lot of the language that we use even up here is around like corporations and the indications of like how that impacts their tax accounting. So I think that's important. And then I think the other principle that's really important to keep in mind is distinguishing like how this technology works. For example, going back to the question of staking and mining rewards, right? A lot of times we've talked about like stock issuance or compensation, but these assets that are created by these rewards are not something that is being paid by some third party, right? Like this is a computer program that's generating these assets. And I think understanding that kind of foundational, like how the technology works is really important to getting these questions right.
Thank you. That last bit will keep me thinking. Yes, Chairman.
Thank you.